Essential preparation for silver holders. With 100 plus ounces, if you currently possess more than 100 ounces of silver in any form, physical bars, coins, ETF shares, futures contracts, mining equities, allocated storage, anything, this video is directed specifically at you, not the casual observer, not someone contemplating their first ounce, at you, the person sitting on a position that, at Friday's close of $84.40 per ounce, carries a minimum value of $8,140 and potentially hundreds of thousands or millions of dollars depending on your accumulation size. Because what's about to unfold in the silver market this week, beginning tomorrow, Monday, February 24th, 2026, impacts holders of 100 ounces or more in ways that are fundamentally distinct from someone keeping 10 ounces tucked away. The decisions you need to reach before tomorrow's open are different. The risks confronting you are different. The opportunities accessible to you are different. And the mistakes that could prove costly are different. Sit down. Close your other tabs. Give me your undivided attention for the next 20 minutes. What I'm about to detail could be the most consequential information you receive regarding your silver position this year. Monday, February 23rd, 2026. The rules are absolute and permanent. I sell nothing. I will never sell anything. No programs, no communities, no signals, no mentorship, no fund, nothing. If anyone reaches out using this channel's name requesting money, they are committing fraud. Report them immediately. This is educational analysis of publicly available data. This is not financial guidance. I'm not a licensed advisor. I don't know your financial circumstances. Every decision you make rests on your shoulders. Protect your capital first. Verify every data point through primary sources. No exceptions. Now here's why 100 ounces is the threshold that transforms everything. The 100-ounce threshold. At current prices, 100 ounces of silver equates to approximately $8,140 in value. That's the minimum at which your silver position evolves from a minor speculative allocation into a substantial financial holding warranting active oversight. Below 100 ounces, you're essentially maintaining a hedge, a modest insurance position, a talking point. The dollar amount isn't sufficient to generate meaningful financial impact, positive or negative. Above 100 ounces, your position becomes material. A 10% shift in silver, which has occurred multiple times in single sessions during 2026, represents $844 or more in portfolio effect. A 31% intraday swing like January 30th represents over $2,600 per 100 ounces. At 500 ounces, that January 30th event meant a $13,000 single-day fluctuation. These aren't hypothetical figures. They occurred 4 weeks ago in a single trading session, and the conditions that spawned that volatility haven't improved. They've escalated. 4 margin increases, vault drainage quickening, Chinese export controls entering day 53, Shanghai premiums expanding, paper to physical ratios at historic extremes. Every volatility amplifier from January remains active, and several have worsened. If you hold more than 100 ounces, you must address 5 specific areas before Monday's open. Each differs depending on how you hold your silver, and mishandling any one of them in the current climate could forfeit a significant share of your position's value, or worse, the position itself. Area 1. Know your exact holding structure and its specific vulnerabilities. This sounds elementary. It isn't. Most silver holders I engage with through this channel's comments cannot precisely describe the risk profile of their specific holding structure. They know they own silver. They don't know what they actually own or the specific ways that holding could be compromised. If you hold physical silver in personal possession, coins, bars, rounds in a home safe or secure storage, your vulnerability profile is the narrowest. You face zero counterparty risk. No custodian can lend your metal. No exchange can margin call you. No ETF sponsor can cash settle your position. No broker can auto-liquidate you at 6:15 p.m. Sunday. Your risk is confined to theft, physical damage, and the opportunity cost of holding metal that produces no yield. In the current environment, this represents the lowest risk holding structure. But it carries a constraint that matters enormously at 100 ounces and beyond: liquidity. Disposing of 100 or more ounces of physical silver rapidly at fair market value isn't as straightforward as clicking a button. Local dealers may lack the cash reserves to purchase large quantities at spot. Online dealers involve shipping, insurance, authentication, and settlement windows. During a price surge, the premium you receive above spot could be substantial. During a downturn, you might encounter discounts below spot as dealers shield themselves by widening spreads amid volatility. Identify your exit channels before you need them. Locate 3 dealers, 2 local and 1 online, capable of processing 100-plus ounce transactions. Confirm their current buy prices relative to spot. Understand their payment timelines. Complete this today, not amid a crisis. If you hold SLV shares, you hold paper silver custodied by JP Morgan, priced against COMEX paper benchmarks, and governed by trust prospectus provisions. including cash settlement under extraordinary circumstances. At 100 ounces equivalent, approximately $80,140 of SLV at current share prices, your position is liquid, tradable on any market day, and carries negligible counterparty risk under normal conditions. But current conditions aren't normal. SLV underwent $3 billion in January 2026 redemptions. Roughly 29 million ounces year to date have departed. The trust holds approximately 560 million ounces, constituting roughly 62 to 70% of all identifiable silver in Western vault systems. The custodian, JP Morgan, concurrently operates as the largest COMEX silver deliverer and maintains one of the biggest concentrated short positions in silver futures. Those structural conflicts are inconsequential during ordinary markets. During delivery crises, they become enormously significant. Your particular risk as an SLV holder with 100+ ounce equivalent exposure is that a paper physical divergence event could cause SLV's share price to follow the paper price downward while physical silver prices hold steady or climb. You'd experience losses on your screen while the actual metal theoretically supporting your shares appreciates. That divergence has already commenced. Shanghai Physical at $94 to $95 versus COMEX paper at $84.40. SLV tracks COMEX, not Shanghai. If the divergence intensifies, SLV holders lose while physical holders gain. If you hold PSLV, your silver is fully allocated at the Royal Canadian Mint with published serial numbers and independent verification. Your counterparty risk runs against Sprott and the Canadian government's mint facility rather than a bullion bank with a manipulation track record. However, PSLV trades at premiums to NAV that can compress during selling pressure. If you purchased at a 4% premium and that premium collapses to zero during a volatility episode, you absorb a 4% loss instantly, regardless of silver's price direction. At 100 ounce equivalent, that's approximately $340 in premium risk. If you hold futures contracts, you occupy the most vulnerable category in the current landscape. Each standard COMEX silver contract represents 5,000 ounces. At $84.40, that's $422,000 notional per contract. With maintenance margin at $23,000 following the latest increase, you're controlling $422,000 of silver with $23,000 of capital, approximately 18-to-1 leverage. A 5.5% adverse move eliminates your entire margin. January 30th's 31% intraday swing would have generated $130,000 in losses per contract. If you hold futures representing 100+ ounce equivalent, which is a fraction of a single contract, you must recognize that your leverage profile places you at acute risk during the volatility conditions presently in effect. If you hold mining stocks, your exposure encompasses silver price plus operational risk, management risk, jurisdictional risk, cost inflation risk, and broader equity market risk. Mining equities typically amplify silver's movements by 2 to 3 times. A 5% silver shift could translate to a 10 to 15% mining stock move. At 100 ounce equivalent portfolio value, a 15% swing represents roughly $1,266 in gains or losses, manageable. At larger allocations, the leverage magnification becomes material. Know which companies you own, their production costs, their debt loads, their geographic exposure, and their hedging strategies. A mining company that's hedged 50% of production at $60 silver will lag an unhedged producer during a silver surge. That distinction matters for your portfolio. Area 2. Calculate your actual cost basis and real P&L position. This matters more than most realize because your cost basis determines your tax obligations, your risk tolerance, and your psychological reference point during turbulent conditions. If you acquired 100 ounces at $25 per ounce and silver sits at $84.40, you're sitting on approximately $5,140 in unrealized gains. Your cushion is significant. A correction to $60 still leaves you profitable. If you acquired 100 ounces at $75 per ounce, you carry $940 in unrealized gains on a $7,500 investment. A 12.5% pullback erases your entire profit. Your tolerance for drawdown is minimal. A single rough day brings you to break even or worse. If you acquired 100 ounces at $110 during January's spike, you're currently underwater by approximately $2,560. Your psychological state differs fundamentally from either scenario above. You're likely anchored to your purchase price, hoping for recovery, and susceptible to panic selling during further declines. You need to plan more urgently than anyone else watching this. Document your cost basis for every silver position you maintain. Calculate your unrealized gain or loss for each. Know where your break-even sits. Understand how much drawdown you can tolerate before unrealized gains become unrealized losses. At 100 ounces or above, this isn't optional. It's the bedrock of every decision you'll face this week. Area 3. Understand this week's specific risks and opportunities. March delivery is approaching. March is a major COMEX silver delivery month. First notice day is imminent. The interval between now and first notice day is when the tension between paper positioning and physical delivery demand reaches peak intensity. Open interest for March contracts represents approximately 340 million paper ounces against 98 million registered ounces. That 3.4 to 1 ratio on March contracts alone, excluding other months, creates mechanical price risk in both directions. If standing for delivery surpasses expectations, price could surge violently as the market reprices to motivate sellers to release metal into the delivery pipeline. That's the bullish scenario. If contract rolling picks up pace and delivery standing proves manageable, the paper system endures another cycle and price could retreat as the delivery crisis narrative loses near-term momentum. That's the bearish scenario. Both are genuine possibilities. Your plan must accommodate both. At 100 ounces or more, you need a written plan for each outcome. Get a sheet of paper and write 2 scenarios. Scenario A, silver surges above $90 during March delivery pressure. What do? Take partial profits? Hold everything? Add more? At what exact price do you execute each action? Write it down. Scenario B, silver retreats below $80 as delivery worries diminish and margin hike pressure persists. What do? Buy the dip, hold, set stops. At what exact price? Write it down. Having both plans documented before the market opens eliminates emotional decision-making during the event itself. Sunday night's Globex open at 6 p.m. Eastern is the initial test. Over 14 months, silver has opened below Friday's settlement 64% of the time on Sunday nights. Average decline in the first 30 minutes when the pattern activates, 0.8 to 1.2%. At 84.40, that's a potential slip to 83.40 to $83 before full liquidity returns. If you're carrying 100 ounces in futures or leverage positions, that 1.0 to 1.40 decline represents $500 to $700 in mark-to-market losses within 30 minutes of the open. Can your margin handle that? Have you already resolved that question? If not, resolve it immediately. Area 4, assess your insurance position. At 100 ounces of physical silver, you're holding approximately $8,440 of portable, easily concealed, universally recognized value in your possession. If stored at home, is it insured? Standard homeowners insurance policies typically cover precious metals only up to $200 to $500 unless you carry a specific rider or scheduled personal property endorsement. If you hold 500 ounces at home, you're sitting on $42,200 with likely $200 to $500 of insurance coverage. That's a 98% gap between your holdings and your protection. Contact your insurance provider Monday morning. Ask specifically about precious metals coverage limits. Ask about scheduled personal property endorsements for bullion. Ask about documentation requirements for filing a claim. Insurers typically require purchase receipts, photographs, serial numbers for bars, and independent appraisals for substantial holdings. If you lack that documentation in order, begin organizing it today. Photograph every bar with serial numbers visible. Photograph every tube of coins with mint marks showing. Store the images in a secure cloud location separate from your physical storage. Keep purchase receipts arranged by date and amount. If you store silver in a private vault or depository, verify your storage agreement's insurance provisions. Most reputable depositories carry insurance covering the full declared value of stored metals, but confirm the coverage amount, the insurer, the deductible, and the claims procedure. If the depository's insurance has a per-client cap and your holdings exceed that cap, you're self-insured above the limit. This isn't thrilling content. It's not about Shanghai premiums or COMEX delivery tension. But at 100 ounces and above, the unglamorous work of proper insurance and documentation shields your position against risks statistically more likely to cause you losses than any single market event. Theft, fire, natural disaster. These risks are real, continuous, and insurable. Market volatility is dramatic but temporary. A house fire that destroys 500 uninsured ounces of silver is permanent. Area 5. Decide your strategy for the next 30 days and commit to it in writing. The coming 30 days are likely to represent the most volatile stretch in silver's modern history. March delivery. Chinese export controls entering their 3rd month with no precedent for reversal. COMEX registered silver potentially falling below 90 million ounces. Shanghai premiums potentially widening beyond $12 to $15. A possible 5th margin hike from CME. Macro data releases including Fed commentary, CPI updates, and employment reports. Geopolitical developments including U.S.-Iran tensions. Every single one of these elements creates potential for explosive moves in either direction. At 100 ounces or more, you need a 30-day strategy, not a vague intention. A specific written strategy addressing these questions. What percentage of my silver position am I willing to sell in the next 30 days under any circumstance? If the answer is 0, write that down and hold yourself to it. If the answer is 25% at $95 or higher, document the specific price and the specific quantity. If the answer is 50%, if silver falls below $75, document that with a specific trigger level. And what additional capital am I prepared to deploy to expand my position in the next 30 days? If silver drops to $75, would you buy more? How much more? With what funds? From what source? If silver surges to $100, would you take profits on existing holdings and re-enter later? At what re-entry price? What is my absolute maximum pain threshold? The price at which you would exit your entire position, irrespective of your long-term thesis. Every position needs one, even if it's $20, even if you believe silver is destined for $200. An absolute floor beneath which you concede your thesis was incorrect, or the market's capacity to remain irrational exceeded your capacity to remain solvent. Write that figure down. If silver ever reaches that figure, execute without second guessing. The purpose of the absolute floor isn't to forecast where silver heads, it's to shield you from catastrophic loss in the event of a scenario you didn't foresee. What is my target for this position over the next 12 months? What would make you consider this investment successful? $100 silver? $120? $150? Having a target helps you gauge whether intermediate volatility is noise or signal. If your 12-month target is $120 and silver declines from $84 to $75 this week, that's a 60% upside opportunity from the dip, not a reason to panic. Context drawn from your own documented target prevents emotional reactions to short-term fluctuations. Write all of this down today before 6 p.m. Place the paper somewhere you can reach quickly. When the market moves this week, and it will move, retrieve that paper before opening your brokerage app. Read your own words, composed by your rational self during tranquil conditions. Then act according to the plan, not according to the fear or greed you're experiencing in the moment. Every data point I've cited is publicly available. COMEX vault data through CME, CFTC positioning through weekly reports, SLV holdings and prospectus through iShares, PSLV bar lists and NAV through Sprott, Shanghai Premium through SGE, CME margin schedules through exchange advisories, insurance policy terms through your provider. All verifiable, all accessible. If you own more than 100 ounces of silver, you own a meaningful position in one of the most volatile, structurally distorted, and potentially explosive markets on the planet right now. That position deserves more than passive attention. It warrants the same caliber of strategic planning, risk management, insurance coverage, cost basis awareness, and structural comprehension that you would apply to any other 8,000 plus investment. The people who will benefit most from the next 30 days aren't those with the strongest conviction. They're those with the most thorough preparation. Conviction without preparation is simply hoping. Preparation without conviction is simply hedging. Both combined is how positions get navigated through volatile markets without being demolished by them. You have until 6 p.m. tonight. 5 areas: written plans, verified data, clear cost basis, proper insurance, known holding structure. The checklist is straightforward. Completing it before the market opens is what distinguishes holders who weather volatility from holders who become its casualties. Verify everything. Plan before you trade. Protect what you own.